So for the trader, if you're going to do it for the money, maybe that's the wrong target.
I think you also put the wrong pressures for the trader.
Right.
I tried to be a trader. I wasn't successful. If I was successful, I wouldn't be working. Because
Right.
I tried to be a trader when I was a private banker. I traded my own money.
Right.
When I traded my own money, I lost money. When I traded other people's money, I made money for them. Why? Because yeah, exactly. When you trade someone else's money, you're more careful. You factor in a thought process. You take calculated decisions. When you trade your own money, all of this goes out the window, and you don't target this professionally as you do for someone else's. It's economies of scale. If I tell you, Dino, manage my money, you need to tailor something to me, and I need to pay you for that. And for you to do it, it needs to be worth your while. So I need to pay you lots of money, or I have lots of money and I can afford you. Well, for me, the retail guy, or many other investors, we can't afford tailored, discretionary asset managers to run for us.
Here we are. Here's another podcast. My guest today is Demetris Tsingis, owner and founder of FINCAP. In this process here, as I'm getting acquainted with YouTube and the posting and this process of digital presence, in the description of these videos, I've got a 5,000 character limit. And I think that's enough to list all your accolades and your achievements. And I think introduce yourself, Dimitri. Tell us a bit about yourself, who you are, your experience, how are you involved in this industry, and let's dig in.
Sure. Well, thank you for having me, and I'm sure that the guests on this on these podcasts have the chance to also understand a little bit more about the industry and the stuff that you do, which is super interesting. So that's one of the many reasons that I wanted to be here as well. A little bit about myself. So I've been in financial services, I think 21 years now. And what I usually say, because I work like twice as much as anyone every day, it's 42 years now that I have work experience in financial services. That's quite a lot. I've dealt with every single facet of financial services, from banking, investment firms, payments, investment funds, insurance now. We handle all facets of financial services, which gives me a very good understanding, and I wake up in the morning happy, in the sense that I have new stuff to learn and new stuff to do every day. FINCAP, yes, I've set it up 6.5 years ago approximately. Now FINCAP is my small baby now has grown into a huge baby of many people, and we're fortunate to cover nearly all the professional services side that someone might need help with in the regulated entity sphere, even listed entities and so on, which I forgot to say. So we're fortunate. I'm blessed to work with very interesting people and very capable people, much more clever than me. And we try to, be at the forefront of financial services, fintech, regtech, high tech, all types of tech, financial services. That's our niche, and that's what wakes me up in the morning.
Wow, that's awesome. There's a lot of cover there, and I don't even know where to start. But I mean, let's just go. Let's just go with this conversation naturally. So. 21 years ago, and that all the experience was in Cyprus, or did you work abroad?
Yeah, I worked in London. My first employer was Arthur Andersen. I rejected several other job offers to go work for the Goldman Sachs of the accounting industry. 6 months later, I understood that the names don't count for anything, as Arthur Andersen, as you know, went bottoms up, and Deloitte and Touche Tohmatsu bought us at the time. The good thing is that I was at a private equity company auditing them. And when the deal happened, all the Arthur Andersen people got let go. So effectively, the only person that wasn't let go was myself. And my partner told me, you're the only one the client knows and they like, so you're going to stay there. So for 2 years, I kind of like was there in their office in Covent Gardens, which was nice. Client was CVC Capital Partners, one of the biggest private equity houses in Europe. And they actually bought like a few healthcare hospitals in Cyprus now. And I just stayed there. So I was sheltered from all this kind of situation. I changed like 10 business cards in 3 years, from different company names, titles, to different titles of myself. But I learned about financial services. I learned about funds. I enjoyed it. I worked. London was great. I left and went to America to do my MBA. And my MBA was in corporate finance, private equity, venture capital, and entrepreneurship. I was triple major. I worked in BNP Paribas in the mergers and acquisitions department in the summer. And I enjoyed it very much. I had full-time offers, but because I was a Fulbright scholar, I had to leave America for 2 years. And I didn't want to leave America, and I didn't want to go back to London. So, and had a lot of family pressure, so they brought me back to Cyprus. So technically, I worked and lived in London and studied in London and New York and America, New York and Philly. And then back to Cyprus, went into private banking, and then and family business for 1.5 years. I survived and then resigned. And then private banking, then back to London, where I was in another consulting firm. I also set up their London office. So I moved back to London in 2016, and then set up FINCAP. So it was kind of like meandering through all types of professional services, financial services, the last 21 years.
There's quite a diversified, range experiences, but within one sector. So the financial sector, which is, I guess, puts you in a position now at FINCAP, to advise and do whatever you do at FINCAP on different firms, whether that is a firm that's to the retail sector or institutional level or whatever it is. And that's interesting. So by profession, I don't know if you mentioned this, but you are a chartered accountant?
Well, title-wise, you're smiling. Title-wise, I think if I count them, I might have 20 professional or other education qualifications.
That's why I said the description of 5,000 characters is needed.
People make fun of me, and I will be very honest. I don't care about riches, and this is the truth. What I do care about, and it's a personal thing, is not how much money I have in the bank account or how much money. Is I love the concept of always working for something and achieving it. And I love doing it in education. Other people do it with money. Other people do it with, real estate. They build stuff and they feel, the pleasure of achieving stuff. For me, I just enjoy, achieving milestones in education. And to be very honest, I don't think that after a point it adds a lot. It always adds, but it adds a lot. But what it drives me is the sense that I always have something to learn and push myself. Now, what I am a qualified chartered accountant. I am also MBA from Wharton Business School. I have more than 12, 13 professional qualifications. Insolvency practitioner, insurance guy recently, SciSec, all the stuff, FCA, all the qualifications because I got approved by them as well. Chartered CISI or whatever it is. I have the mediator. I have 12 of them. It's irrelevant. Like when you're in professional services and you service people, some of them you need, some of them nice to have. Some people just do it just to show lots of things under their name. To be honest, I do it because I enjoy learning. I recently got also the CF, which is like corporate finance qualification from ICAW.
Was that the PhD you told me?
And I'm
recently?
doing a PhD, yeah, which I didn't mention because I don't have it yet. I am at the final stages, and it's a very difficult process because working 16 hours a day and having time to spend on your PhD in the weekends needs a lot of sacrifices, family sacrifices, work sacrifices. I don't really need it. It's not helping me for my work, but I love doing it. I love the research. It just gets to a point in time where you need to look at your priorities. My priorities was my family and my work. So PhD was second priority, meaning that it took me now 7.5 years, but I'm very close now to submitting. So, I don't want to be the number one. Otherwise, I wouldn't be working. I would be only doing PhD. But I just want to tick that milestone as well. It's all about
awesome.
The trip.
Just from that, I take away two points there. One is, and the target audience here is mainly people who are the participants in the sector. So on the B2B level, which we already know, and then also mainly for the end trader who might not have access to the information and insights that we are involved in on a day-to-day basis. They just see, the front end and access to the markets that are provided to them by the brokerage firms. And then on the back, what's happening at the back, I don't know of, where a trader can get that kind of information. So one takeaway there is, and what I've seen many times over is people who are successful in the riches. So you mentioned riches is not, you don't target the money. You do what you like and the money comes. It just happens.
Exactly that. I'm not going to take anything with me, right?
Yeah.
I haven't solved the internal life problem question. So,
So for the trader, if you're going to do it for the money, maybe that's the wrong target.
I think you also put the wrong pressures for the trader.
Right.
I tried to be a trader. I wasn't successful. If I was successful, I wouldn't be working. Because
Right.
I tried to be a trader when I was a private banker. I traded my own money.
Right.
When I traded my own money, I lost money. When I traded other people's money, I made money for them. Why? Because you yeah, exactly. When you trade someone else's money, you're more careful. You factor in a thought process. You take calculated decisions. When you trade your own money, all of this goes out the window, and you don't target this professionally as you do for someone else's. And everyone I spoke to that manages for people money, they say the same thing like me. So it's not just me. It's a behavioral thing. Trading is we're all creatures of habit. When it's someone else's responsibility on your shoulders is huge. Like I wouldn't sleep at night when I had someone else's money on my shoulders. Like I would be, I'm never anxious. I'm never stressed. I would be stressed when I would take an investment decision for someone. He bled for that money. He worked. He had goals. He needs it for his family. And he entrusted it with me. It's like a bigger responsibility than marrying him sometimes. They told me things and information that their wives didn't know or their husbands didn't know.
Yeah.
So the trader, if they take a step back and understand how they need to separate themselves and their thought process, and it's very tough, and I couldn't do it. That's why I was never a successful trader. If I could trade, I wouldn't do anything. It's the nicest thing to do in the world, trading. There's nothing more exhilarating than reading about the markets and trading the markets. You feel as if you own the world. Like literally, you feel as if there's so much information pouring into your brain and you're processing, and you think you can beat everyone.
Why do you think that is? I mean, is it I guess, this is generally that you'd find in, humans, how humans are. Many times if you had to kind of take an outside third-party view on how people treat themselves, they treat other people. Why other people better than what they would treat themselves? And would you say that's, putting up very high importance on the opinion of others? Or why do we do that?
Your thought process gets blurred when you're dealing with your own stuff. when it's your own capital at risk, you don't, unless you're a professional trader, prop trader, which is not your money but for someone else's money, like you're let's say you're an employee that works for a company and you manage their money, you sit in the treasury department of a bank or of an investment firm or a payment service provider. If it's your own money, you said it, and that's the epitome of this emotion.
100%.
It enters into your thought process, it blurs everything, and then you take wrong decisions. I'll give you an example from my experience. I made not much money. I deposited 10,000. It's a true story. I deposited $10,000, euros, I can't remember, in Saxo Bank in 2006, and I've been trading, and now it's 23. So technically, I've been doing it 17 years. Okay, my balance now shows $15,500. I've had more than 100 successful trades over the last 17 years. I had 5 unsuccessful ones.
Wow.
And do the math. I started 10,000. I ended up at some point with 2.5 because I bought the wrong shares. That I was buying like penny stocks. They were doubling up. I was making money. I was happy. And then one day, zero. It's like I had 2 unsuccessful ones that took me to nearly to zero. I built up the portfolio again. But I learned not to trust my emotion. I started doing Warren Buffett style. When it's like bottoms down, only then buy. And then when it goes up, don't be greedy. Sell 15, 20%, fine, sell. If it goes more up, it's fine. If I could win the lottery, I would have won it already. So stop thinking you're going to win the lottery with the trading. Have a strategy, follow it. That's it. Why do computers, I'll ask you a question, why do computers trade better than humans? There's no emotion.
There's no emotion.
There's no emotion. You said it. There's no emotion. Because someone put a thought process without emotion to that computer. And it just like it's technical crunching information. Don't know if you know Man AHL. You're familiar with that? Was the first automated like trading fund.
Man AHL?
Yeah. Man Investors, Man AHL. It kind of got fed into a supercomputer back in the 1980s. Got fed into a supercomputer, lots of statistics, and it just spat out, go buy orange juice this much. Go sell gold for this much. And it just spat out. And they put like orders, and they made like always consistent returns for how many years? They only made one negative year, 2008. Why? Because the markets were simply not following any logic when the markets crashed, Lehman Brothers crashed. So, trading is it's a science. It's not an art.
It's a whole science. It's a skill that you only you get good at with a lot of practice and the emotion. We've said it repeatedly. It's a big one. And whenever you hear about Warren Buffett and Warren Buffett's advice in the books that he's read and whatever it is, the strategy that you follow, you have to stick to it in the long run. And that's why the computers just do what it's supposed to do. Every day the markets, they go up, they go down. If you're going to be swayed by what's happened today in this specific day, which is a little blip, right? It's a little blink in the history past and also the future of a specific stock, you're going to lose.
What you just described, I plead you to do it. You're going to love this book, and your audience as well. Stocks for the Long Run by Jeremy Siegel. Jeremy Siegel is a professor of mine at Wharton. He signed me the book, so I have it. Okay, Stocks for the Long Run. And he statistically proves how he bought consumer stocks like Nestle and things that people consume, and reinvest the dividends over time, irrelevant with markets going up or down, irrelevant. And the return he has versus any other investment was insane. And the only thing he did, he just picked mainstream consumer stocks. He ignored, agnostic to timing, stopped trying to time the market, And whenever they paid dividends, he bought. He reinvested. Whenever, when they didn't pay dividends, he didn't reinvest. And the total return was like 4,000%.
That's right.
Over 30 years.
Wow.
4,000%.
Yeah.
Just because he followed a very simple strategy. Don't try to time it. Don't try to fad it. Oh, it's hip and trendy cybersecurity now, or this, or CFDs, or consumer is something that people just consume. Don't go small. Stop trying to think you're gonna, find a new unicorn company that will boom. Consume like large consumer company. That was his whole template. And that book was amazing. It just explains that, at the end of the day, if you take a macro view, and as an economist by nature, I always take a macro view. Everything that I do, I always say, would people really need this in 3 years' time? Yeah. Does this make economic sense to exist? Is there like a need you're satisfying? If there's no need, then you need to be one of those guru technical guys that follows charts and stuff, which I'll be honest, I don't understand so much. Yeah. And I don't follow. Candlesticks, this and that. I don't understand them. I wish I did, but I never spent time on them. I don't understand them. And I'm not good at statistics either. I was never good at statistics, which is not good for my PhD. But anyway, I was good at math, though, and I could understand the math behind. And I did do the math. Stop trying to beat the day, the week. Look at the fundamentals, take a macro view, and have a strategy.
Yeah, and that notion is in just so many books, right? It's just this one that you've just mentioned, the stocks in the long run. There's also, the Intelligent Investor, which I mentioned in the previous podcast I'm busy reading, which is quite good. And Tony Robbins also, so even if you don't know how to analyze a specific stock, just go on the index, right? Which has got a basket of stocks, and just, America's not going to sink. For example, go on the NAS, there's a consistent 6%, whatever it is, 6%, reinvest it, go back, and the compounding effect is a lot bigger than what anybody could imagine.
Especially if you're a passive investor, Dino. Especially if you're a passive investor, because what people don't get is that unless you're a guru, hedge fund person, which if you were, you wouldn't need anyone. You would sit with a laptop in, Caribbean, make money, and you don't need anyone, or you be in a hedge fund in the States or London and rule the world. Unless you're that kind of guru guy, and 99% of people are not. They're passive investors like me, where their main business is something else, and they trade for amusement, for fun, for education, for whatever for protecting their money, capital preservation. If you're a passive investor, you need the professionals to do their job. Berkshire Hathaway, the stuff that it has in, it's as if you're following an index.
Yes.
It's as if you're following an index. Indexes, the good thing about indexes is that it has to do with market cap, the weights that go in. So if, Apple, that is huge market cap, will make 3% of an index. If tomorrow Apple goes down because the share price goes down, it will become 1% of the index. So effectively an index readjusts its weights according to the importance and what other companies do. But it takes into consideration new companies that do well. So an index is the best way to preserve money as a passive investor. The best way. The other way is to do 15, 20 stocks like Berkshire Hathaway style, which is that the corner of diversification is 15 to 20 stocks. And you just leave them there and they create money. But the trick is to always reinvest. So there's compound. Einstein said about, the eighth wonder of the world was compound interest. And I joke about it in my line of work that recurring income in services is the eighth wonder of the world. If you reinvest it in this compounding, that's when it makes sense. If you don't reinvest and you try to buy new stocks and not, compounded, you will not achieve this.
That makes a lot of sense, and I think the stuff that you just said there is really valuable to the end trader. And I want to dig into two points that you just mentioned: Berkshire Hathaway and an index, and you compared the two. And correct me if I'm wrong, in the way I understood it. So Berkshire Hathaway, obviously, it's Warren Buffett's a company with what's his partner's name, whoever his partner is. And you mentioned it's like an index because Berkshire Hathaway owns a whole lot of other companies underneath it, which are diversified in terms of sector. So Coca-Cola, whatever it is, furniture,
insurance,
insurance. And so Berkshire Hathaway, you would trust your money there because there's the likes of Warren Buffett who know exactly what they're doing, and that quote unquote like an index which is diversified across different sectors is run by, or you trust it with someone like Warren Buffett. Whereas an index, as you mentioned, takes the biggest by cap, the weight. So if today technology is what is a major sector generally in the world, that's going to take primary weight on the index. While there could be a different sector that's got a small percentage today, when that starts up, when that's up and coming, let's say for some reason cotton in the future becomes something super important, whichever stocks are that are related to cotton comes up and bumps up to the top, your index stays with what's trending and what's performing well, if I've understood that correctly.
Correct. So why would someone invest in, we'll take Warren Buffett as an example. There's many of them successful guys. What's the difference? You expect Warren Buffett to beat the index.
Right.
Why? Because he knows stuff that the index doesn't know. So he selects 20 stocks, 15, 20 stocks versus the index that has everyone. So you expect them to beat the index. The problem is that not many people beat the index, even if they claim that they can. And second, something that people ignore is beating the index is not necessarily done with technical or fundamental analysis. I'll explain. Warren Buffett, if you recall in 2008, was the lender of last resort to Goldman Sachs. And if I'm not mistaken, also Bank of America. Okay, he came in when Goldman Sachs share price was $49 and said, "Here's a convertible loan, convertible bond, which I buy at this very cheap price of Goldman Sachs, and it converts at 120 or whatever it is." He could do the deal because he's Warren Buffett and he had the gunpowder to do the deal. Me, with my Bloomberg terminal and 3 people that run a hedge fund from Cyprus or whatnot, cannot do these kind of deals. He can beat the index because he has access to these very niche deals that not normal people have. He can knock on the door to Geico, what his insurance investment is, and tell them, I want to buy X amount of your stock, and through my contacts, your turnover will boost X% because I'm going to open this and this and this door to you. So he's not necessarily only a hedge fund. He's kind of like a combo of private equity / hedge fund guy.
Right.
You can't compare yourself. Let's say banks in Cyprus or investment firms in Cyprus. 3 people in a Bloomberg. I used to do that. So, I'm not making fun of anyone or trying to, put someone down. But you can never do the kind of investments that Warren Buffett does when they're face-to-face with the CEO playing golf and closing deals.
100%.
We buy stocks because we read something on Bloomberg or we kind of have some formula, technical, fundamental analysis. He does a face-to-face meeting with CEO and he defines the company's future. Cannot compare it. So you invest in these kind of people because they have access, which no money can, no number can be placed on it. Now, the index, which you correctly described, that things move and always protect you and you're well diversified, is optimal for the passive investor, especially if it's ETF. Low cost, so there's no high management fees. Warren Buffett might charge you $220 and 2% management fee, 20% performance fee for his fund. When you do an ETF, you're looking at 0.2, 0.3, 0.4 management fee, and no performance fee, and billions in liquidity. So you tick all the boxes. ETFs make so much more sense. You can buy and sell them like stocks. You don't need to put much money in it. Like retail investors like us can buy, sell, no problem. So for the passive investor to buy like indices on ETFs, no brainer for your passive money. For active traders, which I have a hunch your audience, they're the guys that want to beat the markets, the guys that are, adrenaline rush to be star traders and so on. Those guys could do CFDs on indices, So if they have the knack of looking at economics, fundamentals, CFDs on currencies, without being an expert, but, you expect interest rate announcements. Interest rates affect currency exchange. Currency exchange affect, the economics of a country, affect everything. You do a CFD on Euro USD, by definition, you're not big enough to affect the Euro USD. So it will be affected by foreign, variables, lots of variables that interchange each other in importance. Interest rate announcements, Europe versus US deficit, all sorts of sanctions, what have you. Someone needs to be reading and processing this information. It's too much for any human being. Too much.
Yeah.
So you need to rely on third-party analysis. Or you go technical. You do all these charts that I don't understand.
Yeah.
But either or, you need support, you need tools. So I think that's where people like educated people that write programs that help you analyze and have a wiser decision. I'm not jealous of them, by the way. It's a very hard job. It's like I couldn't do it. I couldn't do it, and I stuck to stocks and bonds, which for me it's easier.
Yeah, that makes a lot of sense. So, 100%. So the takeaway there is, it's very different being being able to move a market because of the power that you have and the connections that you have, just like Warren Buffett is versus if you're an investor that's outside, like, someone from Cyprus or, wherever you are, a retail trader with access to Bloomberg Terminal trying to, you're only getting the information afterwards from the media, so there's a big difference there, and it makes a lot of sense. Let's talk a bit about the ETFs, right? Let's talk about these ETFs, the CFDs, what the difference is. So the ETF, for the people who don't know, it stands for Exchange Traded Fund, right?
Correct.
And now, how does that link up to, so from my perspective, I've seen the term many times. I know what it stands for. I configure it as a product on the trading platform. But to be honest, I don't know exactly how that thing works.
I had the pleasure of lecturing about funds, so I can give a very layman's definition. Think of an ETF as a bus, okay? And a bus has an owner, and it has a driver, and it has a predefined set of stops. And then you have people entering the bus with their bags and stuff and exiting the bus. Okay, so in my example of the bus, the people entering and exiting the bus are the investors. The owner of the bus is the person that actually structured this ETF. BlackRock, UBS, Goldman Sachs, whatnot. The driver of the bus, the fund manager, BlackRock, UBS, in order for the people that enter the bus to enter, there's a predefined set of rules, let's call them the terms, conditions, agreement, offering memorandum, whatnot, whatever term you want to use, where you confirm to me that you are going to go from this route to that route, you're going to make these stops, and I can enter and exit at these times, at these stops. That's what an ETF stands for, basically. So someone structures it, they define where they want to go, the route, which is the investment strategy, what things I'm going to buy, what things I'm going to sell, when I do it, how often you can come in and go out, what are the costs to ride the bus, all of this stuff defined. And the investors read it and they decide, I go in and then I go out. Simple. So why do people use ETFs? It's economies of scale. If I tell you, Dino, manage my money, you need to tailor something to me. And I need to pay you for that. And for you to do it, it needs to be worth your while. So I need to pay you lots of money. Or I have lots of money and I can afford you. Well, for me, the retail guy or many other investors, we can't afford tailored, discretionary asset managers to run for us.
So that's what the family office, for example, like a family
Correct,
office.
Family office or even below that, because family office is for very rich people, but even below that, like for you to handle me, I need to be a certain high net worth individual or affluent investor where there needs to be enough money for you to make it worthwhile. If I have 3,000 and I want to invest, you're not going to bother with me. So the way to do it is power through numbers, okay? We join together forces and we go to someone who uses technology to manage our money for a cheaper fee. It makes their time worthwhile because numbers, we pull them together. And it makes your time worthwhile because you have one strategy and you don't need to bother with hundreds and thousands of people's strategy. BlackRock, there's funds that could be like billions and billions. It could be, I don't know how many, it could be over 1 million investors. Imagine having 1 million separate portfolios versus one portfolio and that's it. One strategy, that's it. So ETFs are a magical tool for people that don't have economies in numbers to work their money by themselves. After this success, even fund managers that do private banking or whatever, they use ETFs because they're liquid, they're cheap, the cost ratio is very cheap versus a normal fund.
So when we talk about a normal fund's expenses, if I'm correct, you're referring to, what these terms of the high watermark, performance fees.
Bravo. So 2%, when I said 220, it's the industry jargon, 2% management fees.
Right.
On the net asset value of a fund. So to make it layman terms, you put 100,000 in, they'll take 2,000 every year from you, just for their expenses, salaries, managing. And from whatever performance it makes, they'll take 20%. This is kind of industry standard, 220. 2% management fee, 20% performance fee. An ETF doesn't take performance fee.
So that's a big saving.
It takes 0.3, 0.4 management fee.
Okay. Because of the economies of scale and how it makes sense. When you're dealing with 1 million investors, let's say small investors, and many of them I'm sure are quite wealthy individuals, but let's just say, for example, the majority with $3,000 each. That's a lot of money, right? And it makes sense for the likes of BlackRock. Well, okay.
I have in my in my daily work, I come across also people that want to disrupt this industry of asset management. I know asset managers, and I'll introduce you one. You would want to do an interview with him as well. He's a very interesting guy, who understood this predicament. You have people managing money, okay, and they give you a tailored service, private banking service, mass affluent service. So people managing money, and then you have the fully automated asset management, people like eToro, Zulu Trade, which is like amazing platforms. And it does it automatically for you. But in the middle, there's a gap. There's a gap of rich enough people to deserve some attention, but without someone giving it to them. Because the rich people have the attention because of their number, someone deals with them. And the retail people like me, they can't have attention, so they need to rely on other, automated platforms. The gap in the middle, I know someone that tries to disrupt this and say, I'm going to use technology and I'm going to give you a tailored service as if you were a rich person, but through technology. So their cost is like 1/4 of what it is for these guys, because for these guys, you need around one person for every 70 clients. So one person's salary, costs, office space, fixed costs, or one person for every 70 people. That's the normal private banking investment advice number. If you use technology and make it one person every 500 people, but still give them a tailored service by using technology with applications that give you like a personal feeling, but without having, in 500 people, you would have wanted how many? Like 7, 8?
Yeah.
Whatever advisors, you pay for one. You pay the cost of the technology to set it up and maintain it, but it's a fraction of having 8 people on your payroll, headache of managing them, performances, etc., etc., etc. So you keep your star managers, PAMs, MAMs, whatever you want to call them, and use tech to increase the number of people you manage. It's an interesting industry, the asset management industry, and very difficult to be profitable if you're small.
What kind of technologies is this asset manager? And yes, I would like that introduction. What kind of technologies do you think would be leveraged from, or how for that gap? What kind of technologies? AI?
AI. For example, you have now. You live through your phone every day, right? All your economic life is your phone. Imagine now there was an app whereby everything that relates to your economic life is API'd into that app, the super app, let's call it, which is what I see the world becoming, by the way. Pension, insurance, payments, your card, your crypto exchange, your brokerage, your banking, your funds, your CFDs, your everything, your everything is in that app. There's AI feeding off your behavior, and then recommendations coming through and saying, you know what, Dimitris, you paid and bought in your house, but you didn't put insurance. You're spending too much money and you're not putting enough in the private pension scheme. And by the time you're 60, you're not going to have enough money to retire. What I'm saying is like basic stuff. There's even more complicated stuff that can be answered. But if someone feeds in this AI information and it tailors it to Dimitris, his profile, his needs, the people that he handles, and sometimes you don't even need to tell them much. They just see your payments pattern. They see your credit card history. They see who you pay for things, what kind of things you buy. Think of Amazon, but for financial services. You know that with Amazon, you search for a book, okay? It will kind of allocate it into your economic profile. And then when you log back into Amazon, or if you have pop-ups notifications, it will bring similar stuff and connected stuff and correlated stuff. When each one buys this thing, they buy the other thing as well. It kind of links you to that and it gives you suggestions all day long, and it makes your consumer pattern kind of consistent into a certain basket. Think of it in financial services as well. That's what the world is going to. Same thing with pensions, asset management, insurance needs, hedging, investing, everything. I just think that, you know, the people that will achieve it are people that have lots of user base. Apple, Facebook, Twitter, Google, these kind of huge companies. It's not the banks that will do it. It's people that are fintechy, that have large, followers, and they have immense pockets to spend and create this super app thing.
I think Elon Musk is on the right track there. That's one of his plans, right? Is to take Twitter and make it this super app similar to what WeChat is for China. But what you're talking about is so interesting, and I think if we had to imagine someone actually nail what you just said, which I understand it 100%, and have this app where it's this almost like personal assistant, personal portfolio manager for whatever amount of money you have. I think the majority of people out there, 95% of people out there, will be shocked at the amount of money they waste on things they don't need. Starbucks, coffees, things.
Better value for money.
Yeah.
Or more. Let's say a more institutionalized and professional approach of how you need to manage your finances versus your emotion.
Yes.
I'll give you one example, which I think it's worthwhile saying. When I used to meet with people to draw up their economic profile and advise them of how their economic basket should look like, I always used to take a pen and piece of paper and draw a circle and said, tell me about your investments and what kind of investor are you? And there was this guy that said, I'm a very risk-averse investor, very risk-averse. And I'm like, okay, so you have everything in cash? No. I'm very risk-averse. I have X amount of money in shares of Lagi Bank. I have investments in Romanian real estate. I have 200,000 in cash. I have this, I have that. I forced him to put everything he owns, liquid, illiquid, all types of assets, shares, and non-listed shares, in terms of money value, and to put it down outside his house. I forced him to do it.
Yeah.
And he actually enjoyed the process. By the way, I did that with all my clients / friends that I had to advise. And when I put the numbers down in the pie chart, he freaked out. I said, look at this pie chart. You say you're a very risk-averse investor, and 50% of your wealth are in like one institution. May that be in stocks, may that be in deposits. You're in Lagi Bank. That was before it crashed, huh?
Oh my God.
Before it crashed. And I said, you think that's risk-averse? What happens if and Lagi Bank crashed?
Did he make a move?
He made some move. He was a bit shocked. He made some move, but he insisted in saying that I'm a low risk investor, and he had like 9 million in Lagi Bank shares.
Oh goodness.
And he moved some money. We moved it into like funds. We moved some money. But when Lagi Bank crashed, he called me and said, Dimitris, I should have listened to you. Dimitris, why didn't I listen to you? Why? I said, I'm not going to say I told you so, but all I'm going to say is, like, don't blame yourself. You and 90% of the rest of the people are governed by emotion. And because, emotion will never give you the right result. You thought that, and because that's what you knew for 100 years, the banks are there for 100 years, will be there forever, and that's emotion. You when you invest, you need to remove that and just think, what type of investor are you? You're risk averse? Go put your money in a money market fund. You won't get 8% interest because that's a very high interest. And there's no free lunch in economics.
Yeah, there must be a reason.
Which means that there's more risk than you can tolerate. Put it into a money market fund. Put it in U.S. Treasury bills. And that's it, you know. Risk averse means 70% in spread in like 100 places in low risk stuff. And be willing to not have return. You can't want return and call yourself risk averse.
Right.
You know, there's no free lunch. And that's the major issue that I see in most people. They wake up with a bad decision years later because, you know, they were ill-advised, or someone said something to them and that was stuck in their head, or that's what their family did. You know, I'm a family investor in this company.
Yeah.
So what? It's like, you know, unless you control it, where there you control your fate, Warren Buffett style, you need to decide what type of needs you have, and read, get professional support.
Yeah, I think also, you know, people get stuck or get off track by information bias, so they don't have enough information at their disposal, not enough access, and then also believing, like convinced on some information or status that just may not be true, like in, you know, this case of this investor where he strongly believed, it sounds, that he was risk averse, right?
Formation bias is a very good word, the phrase that you're using. Information bias. Euro USD. Let's go and ask 100 people out in the street, or 100 of your traders, your followers, which are, you know, much more clever than me and follow the markets much more than me. They will all give you a different reason of why it will go up or down or stay the same, right? Yes. They will all give you a different reason. Now, what is safer? What is safer? To do the research yourself and rely on your own process of information, which might be too late, inadequate. You might not have the processing power to process all that information, which you don't as a human being, and you don't control it either. Versus going to Bloomberg, seeing what all these clever analysts write about and taking the average.
100%.
Are they going to be right? Not all the times, but at least the average should point you to a better direction than what you're going to decide. If you're lucky and you get it right once, 2 times, 3 times, but on average, it's all about expectations. What people don't understand is that investing in transferable securities, what that may be, CFDs, indexes, stocks, bonds, whatever, it's expectations. And expectations are governed by emotion, are governed by uneducated people or people without enough information, or people with not enough power to process information, or it's expectations. And the best thing you can do is get a reflection of market conditions through more people than less people, so that you're closer to the expectation of more people. The markets is a mirror of the expectations of what people have in their head. And as I said, if you ask me, I'm going to have a different view from you, or not agree completely, and it's the same with everyone else. It's too many variables.
That makes a lot of sense. So let's talk about FINCAP a bit more, right? Because you mentioned a lot of things. You mentioned insurance. You mentioned reg tech, high tech. What do you mean? So first of all, I mean, I'm sure each one of those topics that I just mentioned is a podcast on its own, another session. But let's go. What are you doing with insurance?
So I realized. So insurance, it was one of the only, I think, financial services vertical that I didn't get into. And we kind of understood that there was a need, where all our clients that were regulated entities needed professional indemnity insurance, client fund insurance, whatnot, in different countries. And they kept asking us for it. So I said, well, since we give, clients all the types of services we associate ourselves with lawyers. We have accounting, external or internal audit, risk management, compliance in-house. We do like reg reporting in-house software. We do IT services now, cybersecurity, IT services, all that, consulting in-house. They kept asking us for insurance. I just added it as a vertical. We keep adding stuff that make professional services sense. So anything that relates to professional services and giving a solution, we add it. It's not. I see insurance as just another solution to clients that they don't care about so much. They just care that their need is covered. And I understand risk. I understand how to credit rate them and follow them and monitor them. So we got an insurance broker license, and we will just also sell to all the rest insurance. But that's just one of 23 things that we do. It's like we.
Good on you. Leave something for the rest of the.
I left the money making. I don't manage money. I don't deal with anything my clients do. I have a very strict rule not to compete my clients. And be transparent about it. It's like not to sell services to forex companies, but have a forex company on the side as well, which is other people's jobs. I just stick to what I want to do, professional services. But I want to do everything that relates to that market.
Yeah, I also believe in, there's an abundance in whatever you focus on. So you're doing 23 things, whatever, even if you compete with one of your clients on some specific service or product, there's an abundance, right? The pie, and with the internet, we are with, the proximity barrier gone. We have access to the world basically wherever you're regulated and compliance, even compliance-wise, you're okay to do. So there's abundance.
To be competing with a client is very hard because we kind of the clients we have all manage money in some sort of way or other. Either asset management or payments or online brokerage or listings, they all have to do with capital. And I don't deal with capital.
Right.
I only help people that deal with capital. So, for example, fund managers use us, and we have a fund management license. We're one of the biggest, but we don't manage money. We help fund managers manage the money. We help the compliance of fund managers. Why? Because they manage money and we don't. That's our strict rule.
So it's a consultancy, and even though you're regulated or licensed to do it?
We use it as a hosting service.
Okay.
So we will never manage money. We host people that manage money.
Got it.
So we stick to our guns in terms of what we know what to do well, and we try to be the best in everything we do. And we're blessed to have like really good people, industry leaders, acknowledged leaders in these industries. But we will never try to do stuff that that our clients do, because it's an unethical and unprofessional, whatever you have it. And it's a small world as well. You try and do it, someone will know about it.
Right.
So we kind of.
I remember when you came from London, that's when I first met you. It was around 2017, and we were discussing it was your first steps with FINCAP and my first steps with DGM Tech. And, you obviously had a much stronger, let's call it, head start, because of the connections that you had with wherever you were before. And I remember this conversation. I go, because for me, it was a bit scary, right? I mean, I was getting into this realm of, am I going to be able to make it? And I asked you the same question. You go, with such confidence, you answered me. You go, don't worry, man. I've got this. I've got this in the bag. And you were, I think you start out there for 4 people. How many people are you now?
I started, thank you for your kind words. I started as one person with 2 juniors. It was the first job subsidized from the labor ministry. And the 4th one was, again, a junior, the first job subsidized from HRDA. So, and I started my PhD, and I was running to Warwick Business School back and forth to take exams, and calling them from the train and emailing them from the train to give them instructions of what to do, because they were sitting in Nicosia in like a round plastic table with 3 plastic chairs because there was no office. And trying to understand what to do, these junior guys. And I was just dropping things on them. They were wearing like 7 hats. It was madness. But you know, and for you the same. I think that if you're a person that loves what they do and they have passion, and you clearly love what you do and you have passion, you're going to succeed in whatever you do. Maybe it will take you more time. Maybe you need a break. Maybe you need a some event that will push or give you tough time, and you need to power through. But good people always will have good things coming to them if they keep trying. Statistically, not you might have difficulties, you might have great wins. Think about our common journey the last 6 years. We survived COVID. I had to, like you, wake up every month and make sure that everyone was paid, which is a huge responsibility for someone.
You need thick skin.
It's a huge responsibility for someone. It's huge sacrifices that you need to do. For 2 years, I was not basically taking anything from the company to make sure I was paying the people, which meant I had, a very small fraction of what I was earning before. Just because I reinvested all my personal money, even my salary, I reinvested in hiring people in order to gain critical mass, in order to get better clients, which then gave me more critical mass to get even better clients. And I just knew that if I keep working hard, some good things will happen.
Yeah. And it's a story that so many successful people who have made it, people who are successful, you hear this over and over, right? The sacrifices, the compromises that you need to make. You need thick skin. It's not the other side is nice. It's nice when you get there, but it's tough. You need to enjoy what you do. And this goes back to what we said at the start of this podcast, is if your focus is on the money only, you're not going to last. You got to enjoy what you do to power through, as you mentioned.
I'll give you an example which I'm not proud of saying, but I'll share it with you. I started 1st of December 2016. I only knew our numbers, like proper numbers, somewhere around mid 2019. like I wasn't even pushing our internal team for the accounting and stuff to make sure to know what we're doing. The only thing that I was looking at was the bank, that I have enough money to pay for the payrolls.
Wow.
I didn't even know, are we profitable? Do we have more expenses than what we, I just managed, was very careful with our expenses, bootstrapped wherever I could. So there was nothing more I could do in that sense. And we didn't even have accounting power to know our numbers. And we're an accounting shop, one of our things, 23 things. And I didn't bother with our internal accounting until June 2019 from 1st of December 2016. Why? Because I knew I was doing the best I could in terms of managing expenses. And I had enough money where I was looking at the bank every day to make sure I have enough money to pay the payrolls. And I knew I didn't spend money on myself or anyone else because I was reinvesting. So that's what I said, the money will, if you keep trying, things will happen. And I don't consider myself, successful or remotely successful. I just feel happiness in the sense that, I managed to find a place of doing business and work and help, I don't know, we're 80 something people now, all the different companies and stuff, to call it a home. And they're building their families through our home, through our family. And, that's that's my success. That's
Well, when you say, you don't consider yourself successful, I think, you are successful. And I think people generally, even, in our small island, whoever's starting out their career, examples like you are good, and in having that confidence that, you'd be able to go through just hard work, determination. You can achieve whatever you set your mind to.
Hard work. That's it. Hard work.
You mentioned.
Hard work, 16-hour days now.
Yeah.
When I'm 45.
Yeah.
When I was young, I started in London, and I wanted to do more than everyone else. And I thought, I was the hot shot. I'll do more than everyone else. And I kept working more than everyone else. And I thought when I turned 40, other people will do the work for me, and I can relax. I'm still working more than everyone else, twice as everyone else, actually, literally twice. I do like 15, 16-hour days, and they do 7.5 or 8. And I work, it's not the hours, it's the quantity and the quality of what you do. I do 100 stuff per hour, and other people take longer to do stuff per hour. And I'm doing twice the hours. Why? Because I have the drive, and this is what I struggle to understand with younger people now, why are you not trying? The whole world is in front of you. Why are you not trying?
And
I was hungry.
When you're younger,
to learn everything, to try for everything. It's like, why are you not trying? Why you're gonna sleep when you're dead? Why you take advantage of your life? You only get it once. Try.
And the big thing is for younger individuals, younger men and women out there, you have the advantage of failing. You can fail. It's okay. For us, it's different. You got families to support, whatever it is. The risk appetite at a younger age, you can try something.
Opportunity cost.
Yes.
This is what is called opportunity cost. There was even a very nice statistic when I was in MBA school where they said that getting an MBA, there's a high correlation. You will not become an entrepreneur because the opportunity cost goes up. The average salary at Wharton was the highest in all the MBAs, $230,000 average salary per year when you graduate, or whatever it is, something very high. And the opportunity cost was very high to drop your salaried, position that you didn't care and become an entrepreneur. So a lot of people didn't become entrepreneurs because of this. Wow. They were afraid to take risks. And because I studied entrepreneurship and is my PhD as well, and I used to lecture it for 15, 16 years, entrepreneurship. By saying it so many times, I convinced also myself that, unless I do stuff on my own, I will never get out of my comfort zone and never challenge myself to the limits.
100%. And you know what? I think I need to maybe even correct myself there. So we're at 45. It's not too late. The owner of KFC.
I was going to give you that example. You took it out of my mouth.
65 years old.
Man, it's never late.
It's never too late.
I'm doing a PhD at 45 with 2 kids and 16-hour days. It's never late for anything. It's desire, drive, and a mindset that will stop excuses blocking you from being personally happy and successful in whatever you consider success. Because that currency is something that it has different definitions in people's heads.
It's variable.
Yeah. My success is sheepskins. Your success might be, your family. Other people's success might be money in the bank account.
Yeah.
Other person wants to be the best trader in town.
Dimitri, believe it or not, I think we've been speaking here for an hour. The time is up. We can literally go for another 5 hours, I think.
I'll charge you then afterwards.
This is, this has been good. There's so many things. I wanted you maybe to talk a bit more about FinCap and whatever it is. You mentioned 23 things. I think let's do closing comments now because we're going to veer off into another discussion of another 30 minutes. Let's do closing comments. where can people find Demetris Tsingis, where, FinCap, whatever it is. Thank you very much for your time. This was an awesome one. Thanks.
Sure. Well, thank you for having me first, and I'm honored to be, a part of this very successful elite team you have selected to be part of your podcasts. I feel blessed in the sense that I have access to a lot of information and important people in this industry, and CEOs and CFOs, both from work and also my PhD that I'm interviewing them. And I get to know, how they would think and how they work and what they do, especially in the online brokerage space, which is, my niche. One of my niches. I think that, if someone wants to get hold of me, they'll find me on LinkedIn, and they just Google me, FINCAP.com. They'll find me online. It's very easy to get hold of me. My website is 6.5 years old. I'll apologize from now. It was when it was me and 2 juniors, and we're in process of changing it now. But see how much importance I put in these kind of things. I've never spent on marketing or advertising, ever. We don't even have any advertising material. It's just, soft copy. We were ESG compliant a long time ago. So
I'll cover you there.
To your audience, I think that the important things, takeaways from our very pleasant conversation is that work hard. That's the recipe for success in everything you do in life. You can find thousands of excuses, to not do something. But when you achieve something, if it's worth it, put the excuses aside and just train your brain to achieve things. And the journey, enjoy the journey, so that by doing that stuff, you'll die a happy person, And that's it. It's a simple logic in life.
I love that. Thank you, Dimitri. Thank you for your time. I always do a fist bump with my.
Thank you.
Thanks. And that's a wrap.